Okay, good morning. Welcome to this morning's webinar, Planning for the Unexpected. My name is Leah Flores, and I'm a benefit plan advisor here at MERS. And today, I'll be sharing some tips and best practices to help you build an emergency fund for life's unexpected expenses. So joining me today is MERS Benefit Education Specialist, Candice Skinner.
Hello, everyone.
Candice will be helping me answer any questions we receive, so please feel free to submit those questions throughout the webinar. Just a few reminders before we begin today. Throughout the presentation, you can submit questions using the Questions tab on your control panel of your screen. If you have any questions related to your personal account or investments, I do suggest that you contact our MERS Service Center by calling 1-800-767-6377, as we will not be able to answer those questions during today's webinar. And then if you do send in some questions that we do not get to, we will make sure everybody will receive an answer. We will post a video of today's webinar to the MERS video library within the next week. Also, the link to the video library will be emailed to you following today's webinar. And finally, after the webinar, you will receive a 6-question survey, and we please ask you that you fill that out, as it does help us improve our future presentations. Okay, let's get started. We have a few publications to supplement the information we're providing during the webinar today. First, the Financial Goals Workbook. Second, a Planning for the Unexpected handout. Next, the Supplemental Savings Options handout. And finally, the Budgeting Tips for Children and Young Adults handout. You can access all of these by clicking on the links under the Handout section on your control panel on the screen right now. And additionally, links to all of the above will be sent to you in a follow-up email after today's webinar. So today, we will talk about the importance of having an emergency fund and how much to save in that fund. We'll review other important considerations and tips and best practices for saving. We will talk about other sources to fund your account and review tips for teaching children and young adults about finances. Establishing an emergency fund. I'm going to start by sharing a little scenario that some of us, or many of us, have at least experienced in some way. Imagine you start your week and your engine overheats in your car, and then your spouse falls and breaks a bone and needs surgery, resulting in thousands of dollars in medical bills. And then to make this bad week worse, your refrigerator stops working. Well, we know that luckily weeks like this are rare, but they do happen. And I ask you, are you prepared? Would you be able to cover these expenses without having to use a credit card or calling a friend or a family member to ask them for help? According to a recent study, just 40% of Americans could pay an unexpected $1,000 expense, such as any of those I just mentioned. So that means 60% of us would not be able to come up with this $1,000 at a moment's notice. And that is alarming, but that's why we're here today, to make sure we're taking the right steps to be prepared. We're going to discuss the importance of having an emergency fund and the best practices for using it. We'll also review how much you should have saved up based on your situation and the tools and resources available to you to start building a supplemental savings account. A few bullet points to emphasize what emergency savings truly is. First, an emergency fund is essentially money that's been set aside to cover any life's unexpected events. This money will allow you to live for a few months should you happen to lose your job, or if something unexpected comes up that will cost a fair chunk of money to cover. Second, you should be able to access this money quickly and easily if some unfortunate event happens to occur. And finally, your emergency savings should be separate from the other things you're saving for. The goal is to not have to dip into your retirement savings or any other savings goals you have set for yourself just to pay for these unexpected expenses. So now that you know how important it is to have your emergency fund, let's talk about how much you personally should have in your own emergency fund. How much should you save? We'll start with the top of this slide, 3 months, or when 3 months of take-home pay may be enough. If you are in a situation where you're a renter and you have only your mouth to feed, you have a steady paycheck and have a strong support network, meaning you do have the option to move back home with your parents if necessary, then having 3 months worth of take-home pay in an emergency fund may be sufficient. Essentially, not bearing the responsibility of a mortgage or minor children makes having this emergency fund of more than 3 months a really nice thing to have, but not necessarily a must-have. Another big factor here is whether you have a reliable safety net. For example, relatives or close friends who would gladly take you in or help you out if you were in dire straits. If all of this describes your situation, once you hit the 3-month mark, you can feel comfortable directing more of your money towards other big financial goals, like paying down debt or saving more for retirement. Now, the second scenario, 6 months, when 6 months of take-home pay may be enough. This is the most popular emergency fund rule of thumb that you may have heard before. That's probably because it applies to the largest group of people. So, are you married with kids and you own your own home and have 2 steady paychecks coming in? In this scenario, you should consider building an emergency fund equivalent to 6 months of take-home pay of the highest earner in your household. There are many other scenarios that fall under the 6-month guideline. Example, married with kids but still have a mortgage to pay. Married yet have a single income and you rent and have dependents. And then finally single and you own a condo. So basically, if you own your own home or have kids under the age of 18 with no safety net to speak of, or any combination of these factors, 6 months is a good benchmark to aim for. And then finally, the bottom 9 months, or when 9 months of take-home pay may be needed. There are some instances when you may need this larger emergency fund, and most of this has to do with whether or not you've got a steady paycheck. So some scenarios in the 9-month rule include if you or your spouse are self-employed or are a full-time freelancer. In these instances, chances are higher that your income is less predictable. For example, 1 month you could be juggling 10 deadlines and working 60 hours a week, and then the next month could be spent waiting around for business to come through. So in a nutshell, the more unpredictable your income, the more you could find yourself thrown off by a chipped tooth or a fender bender. So that's why having an emergency fund of 9 months of the highest earner's net income, this may help and give you peace of mind that you could weather a financial storm. And then the 369 guideline is merely that. It's only a guideline to help you assess whether the size of your emergency fund can help you sleep a little better at night. So we do, however, encourage you to try to meet those benchmarks that most closely applies to your situation. Okay, other extremely important considerations, above and beyond just saving money for an emergency, you want to make sure you have the proper insurances in place, such as health insurance, auto insurance, or homeowners or renters insurance. Also, in addition, life insurance for you, your spouse, and any dependents. This can be invaluable in an event of an unfortunate emergency. Many workplaces offer group life insurance options, but if it's not available to you, it is recommended that you consult your insurance provider or a financial planner to see what options you have. And don't hesitate here. The younger and healthier you are, the lower your premiums will be when it comes to life insurance. Now, something I hear quite a bit when I'm out meeting with participants is, it's hard enough to pay the bills. as it is. So where am I supposed to come up with this extra money to fund an emergency fund? Well, one key to saving for this type of fund is to have a budget. And recently we held a webinar on this very topic. And if you're in this situation, if you have these thoughts, I highly recommend that you take the time to visit this short webinar. There's a recording available on our website. In that presentation, we cover topics such as how to build a budget that's aligned to meet your savings goals. And we covered tips on how to reduce your monthly expenses in order to find more income to save for things like this emergency fund. So please do check that out on our website. Before we move on to emergency fund best practices, I'm going to check to see if we have any questions here. Okay.
We do have one to point out on the handouts available that Leah mentioned at the beginning. There is the financial planning workbook is missing, but shortly after this webinar, we'll email the link to download all of the publications that we are talking about.
Great. Thank you, Candice. Yeah. Okay, so we'll move on to the best practices when it comes to our emergency funds. While we're building or after we have the funds in place, it's so important to keep it there for emergencies. So do not touch it unless it's an emergency. As I mentioned earlier, your emergency fund should be accessible on short notice, but it should not be so accessible or conveniently located that you're tempted to spend it on other things. In other words, a best practice would be, do not connect this money to your checking account. Better yet, you could even set up an account for an emergency fund at a different bank or credit union that's separate from your everyday bank. This reinforces the idea that this fund is only for emergencies. We will review a couple more emergency fund savings options further along in the presentation. Okay, let's talk about our spending habits. With an emergency savings fund established, restrict withdrawals to unexpected emergency expenses only, as we mentioned before, and dipping into your fund for any other reason will only defeat the purpose of having this fund for you. And it may leave you empty-handed when a real emergency does arise. So before using your emergency fund to pay for anything, ask yourself these three questions. First, is this unexpected? Second, is it necessary? And third, can it wait? So let's look at number one, is this unexpected in some scenarios? Your emergency fund shouldn't be used for every big expense that comes along. For example, a 6-month auto insurance premium can be a hefty bill, but since you know when it's coming, it's not unexpected. It's something that you should be budgeting for all along with all of your other regular expenses. Yet, on the other hand, needing to pay your auto insurance deductible after a car accident is an unplanned expense. Second, is it necessary? Some scenarios there. If you break your leg playing football, a trip to the emergency room can be costly, but obviously it's necessary. But a trip across the country to go watch your favorite team play in the Super Bowl may seem like a can't-miss opportunity, but it is not necessary. And then the third scenario, can it wait? Here, if your apartment building has a fire or a flood, you may need to find a new place to live in a hurry, and you will incur those moving expenses that can't wait. But that doesn't necessarily mean you should convert your entire emergency fund into a down payment on a house. So to sum up, if the answer to the first two questions are yes, and the answer to the third is a no, then it's okay to use your emergency fund. That actually is what it's there for. Yet if the answer to the first two questions are no, and the third is a yes, you may want to reconsider dipping into that emergency fund. So now we're going to talk about unplanned income and some sensible options if this were to happen in our future. If we receive a pay raise or a larger tax refund or an inheritance, This extra cash can make a difference in our finances. So it's important to think very carefully about how we're going to use it. If you do have credit card debt or high interest debt, paying this off would be a good move. But a little extra money could also give a really nice boost to your emergency fund. So at least consider putting even a portion of these unexpected dollars into your emergency fund to help build it if needed. As I mentioned before, we're going to cover some ideal ways to build up your emergency savings account. So the most obvious is to set aside money each month, specifically for that reason. However, it's not always possible, and we all have competing savings goals. For example, is it more important to save for retirement or save for an emergency? Well, they both are very important goals, and there are ways that you can achieve both goals. Supplemental savings programs are used as an extra way to save money to help fill any gaps in your retirement funding. They can also act like an emergency fund throughout your working career. So with these programs, you decide how much to contribute, and you can start and stop your contributions at any time. Two supplemental savings options that MERS participants may have include the 457 program and an IRA. So we'll review these two options. First, we're going to start with the 457 Supplemental Savings Program. This is a voluntary account in which a portion of your salary is deposited into an invested account that you manage. This type of account is designated specifically for public sector employees. Your account benefit is based on the total amount of money in your account when you leave your employer. So a great advantage of the 457 program is the fact that you do not need to be a certain age to start using your account balance. So the pre-tax 457 is available for you to use tax penalty free once you leave employment, regardless of your age. MERS does offer a 457 program that you can enroll in as long as your employer has adopted this plan. In relation to emergencies, some 457 programs offer hardship withdrawal features. This is an option of taking an emergency withdrawal in the event of a severe financial hardship. Examples of qualifying hardships include the sudden and unexpected illness or accident, loss or damage to your property due to an accident, disaster, destruction, or theft, or other severe and unforeseeable circumstances. So the MERS 457 program does allow hardship withdrawals from your pre-tax account. So if you or your primary beneficiary has a qualifying need, as mentioned above, this is when you can use that. However, it's important to note that if you do receive one of these emergency distributions, you cannot make further contributions to the account for a 6-month period, and your employer must provide final approval for all such requests. Next, another supplemental savings program. The individual retirement account or individual retirement arrangement is commonly referred to the IRA. An IRA is a tax-advantaged individual retirement account. MERS members and their spouses can use a MERS IRA, and the membership includes current and former employees of a MERS partnered municipality. So for the MERS IRA, no employer adoption is necessary to enroll. There are two IRA options, Roth IRA and traditional IRA. A Roth IRA provides tax-free income in retirement. And then the traditional IRA allows tax-deductible contributions now or in your earning years. Now let's talk about the flexibility while saving in an IRA. The flexible saving option allows you to withdraw money prior to retirement without penalty for certain qualified expenses. And those are, first, education expenses for you, your spouse, your child, or your grandchild. Next, buying or building your first home up to $10,000. And finally, unreimbursed medical expenses. So as you can see, there are no penalties for withdrawing money for qualified expenses, although you may be required to pay some income tax. So why choose a Roth IRA? First, we're going to start with tax-free earnings. The Roth IRA makes an excellent retirement saving strategy if you're making after-tax contributions. So whether you make lump sum contributions to the account or establish some type of payroll deduction out of maybe your checking account, you can do this each pay period. You have already paid taxes on those dollars. That means you can withdraw your money without having to pay additional taxes on it or the investment earnings it makes over time if you meet the requirements for a qualified distribution. And those are those two requirements, that you have to be 59 and a half and it has to be in there for 5 years from the initial contribution. Then the next bullet point, emergency savings. This is a great part about the Roth IRA. You can withdraw your contributions, so actually what you've put into the account, at any time to cover unplanned expenses. This makes a Roth IRA appealing if you're trying to build your retirement account and your emergency savings at the very same time. So if that emergency does not come up and you do not need the money, great, excellent. Your money's there for you, tax-free in retirement if you met those qualified distribution requirements. If you actually need the money for an emergency, you can withdraw your contributions from a Roth IRA tax-free at any time without paying a penalty. Only your investment earnings need to remain in the account until you're 59 and a half to avoid paying that 10% penalty in income tax. And finally, the last bullet point, the estate planning. Traditional IRAs require you to begin taking required minimum distributions, commonly known as the RMDs, at the age of 70 and a half. A Roth IRA has no RMD during your lifetime, which means your money can grow in a Roth IRA and be passed on down to your heirs. So we've talked about these great options, but how can you get started? Again, both of these supplemental savings programs, the 457 and the IRA, you can start, stop, or change what you're contributing at any time. So you have to know how to enroll into the plans, in either plan. So first we'll discuss the enrollment in the MERS 457. If you're interested in enrolling, you'll first want to check and see if your employer has adopted to ensure you're actually eligible. If you are, you can find more information and this enrollment form as shown on the screen to the right on our website at www.mersofmich.com. If your employer has not adopted the MERS 457 program, let's discuss the IRA enrollment. So again, if you're enrolled in a MERS retirement plan, such as the MERS Defined Benefit Plan, the Defined Contribution Plan, the Hybrid Plan, or the 457, both you and your spouse are eligible to open a MERS IRA, and your employer does not have to adopt the IRA. Again, you can find more information and submit a request to receive an IRA application on our website. Just to give you a little more information on how the application process works, as I mentioned, go to our website. At the top of the screen, you'll see a rotating banner. You choose the IRA banner, which looks exactly like the picture on your screen on the top of the flexible savings option handout. Once you click that banner, you will see all of the IRA information, and on the right-hand side of your screen, you enter your personal information that they request. After you push submit, MERS will confirm your membership and email you an IRA application. So we'll take a little break here to see if there are any more questions coming in. Don't see any yet, right?
We've
okay with that.
We do have one question.
Good.
We're wondering how much money can I set aside in the MERS 457?
Okay, so the limits this year for 2019, great question. The limit for 2019 is $19,000 that you can set aside in your MERS 457. If you are age 50 or older, you can set aside an additional $6,000. Great question.
And one other question, how much money can we save in the IRA?
Good question too. For this is important to note, for the IRA, you can actually contribute to an IRA for the year 2018 up until the point you do your taxes. So the 2018 contribution limit is $5,500, and there is a age 50 catch-up at age 50, and every year thereafter you can do an additional $1,000. And that limit applies to both you and your spouse, so you can each do that amount. And then the 2019 limit is $6,000, and the age 50 catch-up is an additional $1,000 again.
Perfect. Thank you.
Thank you. Now let's talk about a very important topic, our children and financial education. Did you know that studies show that most youth today, 69%, still rely on their parents as their leading source for financial knowledge? And that's great to hear. They're listening to us, they're learning from us, but what are we teaching them? In an effort to help you educate the next generation of super savers, we have some budgeting tips and resources broken down by age group that you could actually share with your kids, your grandkids, or any other younger audiences that you think would benefit from this information. So as a reminder, we have a handout with all of this information that you can download, even right now on the toolbar, and it will also be emailed to you. So let's spend a few minutes reviewing some important objectives that each age group should be learning. So we'll start right now with pre-kindergarten to second grade. And at this time, they should be at least being introduced to money, like how it's earned and how it's saved. How can we introduce these topics? We can concentrate on different topics for each age group. So through the pre-K through second, we have understanding currency, earning money, and savings and spending. And I'm going to quickly give you some discussion topics and items that you can do with your children under each subtitle. So understanding currency. You could describe the purpose of money, examine and discuss the history of money, explain ways money can be used, or identify, sort, and count coins and bills. Under earning money, you could identify and explore different jobs, examine sources of income, such as selling lemonade or receiving birthday money, and discover and explain that money is made or earned by working. And then finally, saving and spending. You can identify and evaluate saving and spending, recognize a bank as a safe place to save, and help them create a savings jar or a piggy bank. And then as we mentioned before, all of this information that I'm discussing will be provided in that handout. So I'm just running through some discussion topics for each age group. And as we get to the grades 3rd through 5th, we want to begin teaching them about buying decisions and help them understand truly what a budget is. So under buying decisions, we could explain the difference between needs versus wants and identify some examples of each of them. We can compare and prioritize needs versus wants. We can evaluate different choices when making a purchase and discuss impulse buying, just when we're walking through the store or making shopping trips. Under budgeting, we can explain what this term means to them, identify categories of budget, so income, expenses, and savings, and create a budget. Under savings, we can explain what banks do and what interest is. We can name benefits of saving money in a bank versus at home, and maybe evaluate real-world scenarios that focus on saving for emergencies or unexpected events or purchases. Now, as our children become more financially savvy, so do the lessons we should teach them. So grades 6 through 8, it's a good time to start talking about wants versus needs, maybe more in depth, and how we're making our shopping decisions. Now they might be earning money with chores, and you may want to teach them how to create their budget. This will help them understand more about savings, and it's also a great time to introduce the concept of investing with them. So under each bullet point, a couple of points of discussion. Under smart shopping, let's consider the roles of needs and wants in decision making. Let's evaluate the credibility and motivation of marketing and advertising. Under cash flow and budgeting, we can explain the purpose and value of budgeting. We can also explain the budgeting categories, the fixed expenses versus variable expenses and discretionary expenses. And then finally, under the savings options, once again, we can help them evaluate and differentiate a variety of banking and savings options, and we can identify the benefits of creating a savings account. So then on to our 9th through 12th grade. At this point, they should start learning the real-world concepts, such as determining what kind of career they want based on the lifestyle they want to lead, and the importance of building and maintaining good credit and how they plan to finance college or whatever they decide to do after high school is over. So once again, discussion topics, a couple under career options. They really want to start thinking about their careers, identifying career options, and education or training required for different careers. Maybe demonstrate how to research and analyze all those different careers. Under credit, helping them understand creditworthiness and evaluate positive and negative types of credit. Maybe discuss how to maintain or increase credit score. And then finally, the financing college portion, of course, identifying the cost of college, discussing student loan management, and even discussing the earning potential of a degree in relation to what it actually costs. So this is a great time to begin teaching young adults also the importance of having an emergency fund. Obviously, of everything we talked about in our emergency funds, at this point in their life, their emergency fund is not going to be as great of need as ours is, but we can teach them to have small amounts of money set aside in case they possibly run out of gas in their car, or possibly get stuck at an event and they need the money to Uber home. These little tips can help play a big role in how children view and use money as they're moving into adulthood. So now we have some more time for questions. Any more questions, Candice?
Let's take a look here.
Okay, yeah, we see one question. Is Hartford deferral similar, same as a 457? You know, when I talked about the 457, a 457 really rules and regulations set up. A 457 can be used by a municipality employee. So whoever holds a 457 or administers the 457, primarily the rules I discussed are all the same. Yes, if you have something with them that you may want to reach out and ask particular questions with them. But if you have any questions and you're a MERS member, definitely call the Service Center and we can help you on that individual basis. Any more questions, Candice?
I think one last one is, can my child use an IRA through MERS? I know that we talked about and then employee and a spouse.
Yeah. Okay. Good question. Right at this point in time, the MERS IRA is set up for only the member, the participant, and their spouse. And no, at this time, your child cannot use the IRA through MERS. I guess more to come. If anything changes, you will definitely be alerted through our emails. So I think that, any more?
Nope, I think that's it for now. So
okay. Thank you, Candice, and thank you all. That brings us to the conclusion of today's webinar. Thank you so much for joining us.